downsizing or equity release, which one actually leaves you better off? Well, the simple answer is that neither wins by default, and the reason has almost nothing to do with the interest rate that you might get. You see, downsizing frees up far less than most people actually picture, and equity release costs far more than a lot of people fear. And once you see both properly, I think the deciding question turns out to be a completely different one. So if you've been staring at your home thinking, well, there's my retirement fund, well, this video is going to be for you. So my name is Hussein. I've got over 25 years of experience of helping people plan their money and their finances. And if you find this kind of content useful, please do like the video and subscribe to the channel. Now, most advice on this topic treats downsizing as the sensible, free option and equity release as the desperate, expensive one. But after years of talking to people about this and helping them think through their choices, I can tell you it is very rarely this simple. And I'll show you in this video what the average downsizer actually walks away with and what equity release costs once the interest starts rolling up. So by the end of the video, I think you'll realise the number that you've been agonising over isn't the one whether this decides whether you should do this at all. There's also a free retirement checklist on our website, financialeducation.co.uk. It's got everything you need to think about regarding this topic. So everything to sort out before you retire is in this video. So let me start with the option that everyone reaches for first. That is the classic plan. So picture this: sell the big family home, buy something smaller, and basically pocket the difference. And essentially, it sounds like free money. And for decades, I guess that was the whole idea. But independent research from the equity release advisor Key find that the reality is actually far less generous. You see, start with a £320,000 sale and a modest step down to say a £260,000 home. Well, estate agent fees are going to take around £4,500, stamp duty another £3,000, legal and moving costs roughly £7,000 more. So by the time the dust has settled, you've released about £44,500, not the £60,000 that you thought. That's a quarter of your gain gone before you unpacked a single box. Now clearly some of these numbers will be different based on individual circumstances, but hopefully it gives you a bit of an idea of the angle I'm trying to take here. And that is right in line with Key's own finding. You see, the average person who downsizes releases about £46,000. And the trade-off does buy you something real though. See, a smaller home cuts your running costs. You've got lower bills, less to heat, and one less boiler to worry about when it packs in. So for a lot of people, that alone is worth moving for. But as ever, there's a catch with downsizing, and that rarely gets said out loud. You see, Key's research found that 1 in 3 downsizers tried to sell, and basically they just gave up. See, there's a genuine shortage of bungalows and ground floor flats retirees typically want to move into. So the moves that you're banking on might not even be available. So that means that downsizing isn't the guaranteed windfall that it's sold as, and that changes how you should think about the alternative. So let's turn to the option that you may be nervous about, which is equity release. And straight away, I want to challenge its reputation because it's not the product that your parents or your friends may have warned you about. You see, the modern version of a lifetime mortgage, which is the typical equity release mortgage, makes up 99% of the market. And here's how it works in plain English. Basically, you borrow against your home and you stay living in it. You don't sell and you don't move. Nobody can make you leave. So you make no monthly repayments unless you choose to. The loan and the interest are only repaid when you die or you move into long-term care. So these are the 3 key things about how the lifetime mortgage works. And really importantly as well, it is very tightly regulated by the Financial Conduct Authority, or the FCA. And if your plan meets Equity Release Council standards, it comes with something else that's really, really important, which is called a no negative equity guarantee. So basically what that means for you and your family is that you can never owe more than the home eventually sells for. So the market has grown up to, you say in 2025, homeowners release over £2.5 billion this way, and the average customer is now around 70 to 72. So more people are doing it at a slightly earlier age. Now, here's the first rule I think that pays for anyone watching the video, and that is only borrow what you actually need. You see, take £30,000 instead of £100,000, and 15 years on, the debt is a fraction of the size. So the bigger draw balloons to nearly £240,000, whilst the smaller one barely passes £70,000. So every extra pound that you borrow today costs you far more down the line. So for me, the catch is simple. Don't let an advisor talk you into the maximum when the smaller sum would do. To again, to reiterate, only take what you actually need, not anything more. You can always go back and get more later on if you find that you do need it. So all that brings us to the thing I think that genuinely makes equity release expensive, and it really isn't the headline rate. So take only what you need, as I said, and the whole picture looks very different from the horror stories. If you are in retirement or planning retirement, I'd really recommend that you do consider whether equity release is an option that would be beneficial to you. And to do that, I'd recommend you use our calculator to see how much you could potentially borrow. So to use our calculator, go to our website, financialeducation.co.uk, and across the top, you'll see some headings, and one of them is equity release. So if you go up to that, you'll see underneath there's a title, Equity Release Calculator. So if you just press on that, that'll take you to a page with a calculator on there. If you just scroll down a little, you'll see there's a calculator down here that you can borrow. Just put in your details and it'll take a few seconds and it'll tell you exactly how much you are able to borrow, which in turn will help you to start doing some of your own retirement planning. You see, it's not the interest rate I think that catches people out. It's what compounding does to that rate over time. Because you're not making monthly repayments, the interest gets added to the loan, and then next year you pay interest on top of the interest. So think of it like a credit card balance that you never touch. It doesn't just grow, it grows faster every single year. And today's rates, I'll say around 6 to 7%, that debt roughly doubles every 12 years. So let me show you what that looks like if left completely untouched. So this is £80,000 borrowed at 6% with nothing ever repaid. So by year 20, it has climbed, as you'll see over here, to over £256,000, which you see there is more than 3 times what you borrowed. And that's the number that comes out of your home sale and out of whatever you hope to leave behind. So these numbers are really important to understand. So on the face of it, this looks like the really expensive option, and downsizing looks like the cheap one. If you took the maximum, made no repayments, and lived another 25 years, it generally could be. And that's the real cost, and no decent advisor should hide that from you. But that worst case number is a choice, not a certainty. And there are 2 things I think that change the math completely. The first is a rule that transforms everything you just saw. You see, almost every modern plan that meets Equity Release Council standards lets you make voluntary repayments up to 10% of what you borrowed every year with no penalty. So on an £80,000 loan at 6%, the interest is about £4,800 a year, and that sits comfortably inside the 10% that you're allowed to pay back. So if you can afford to cover just the interest, the debt stops growing altogether. And have a look here and watch the 2 pass. And if you leave it untouched, and it climbs away from you. But if you service the interest each year, which is in green there, it holds almost perfectly flat. So same loan, same rate. The only difference is whether you can chip away at it or not. So it's really important that you do have a look at these things. So the honest catch is that this only works if you've got the income to spare. And plenty of people releasing equity don't. But if you can, you must check your specific plan allows those repayments before you sign. The second thing that a lot of people miss is the trap that quietly costs you benefits. You see, if you take a big lump sum and it sits in your bank account, cash above £10,000 starts to affect means tested benefits. So for example, universal credit, once you're above £16,000, they can potentially stop altogether. While pension credit doesn't necessarily cut off, but keeps reducing the more that you hold. So the fix is to take the money as a drawdown facility instead, which basically is a pot you can dip into only when you need it. So it never piles up in your bank account. And just be aware that deliberately running down cash to keep a benefit can also count against you. So it's worth checking your own position with a benefit advisor. So here's where the whole comparison, I think, starts to flip on its head. So you spent this video weighing up costs against interest rates, but that for me was never really the question. Downsizing and equity release are just two different answers to one simple thing. Do you actually want to leave your home, or do you want to stay in it? You see, if this is a house where the grandchildren come to stay, where the memories are, you'd be heartbroken to leave, and the interest rate isn't the point. Staying put and releasing some value might be worth every penny or what it might cost you. But if the big house has become a burden, too many stairs, too many rooms that you never go into, the garden being too big, then downsizing isn't necessarily a cost, it's potentially a relief. And your own health and life expectancy matter here too. See, the fewer years the loan runs, the less roll-up costs your estates. Equity release also earns its keep, bridging the early years of retirement. If you stop work before your state pension starts and your pot can't stretch, or releasing a little bit from your house can help buy you those extra years and allow you to retire. So for me, it's to just go in there with your eyes open, remembering that the debt compounds, it's repaid when you die or you move into care, and it reduces what's left for your family. So for me, it's a genuine trade. It's not free money, which is exactly why it needs proper regulated advice, not a decision made off just by watching this video. So a single question, which is to stay or go, decides far more than any number that I've shown you. So the move that pulls all of this together is this. And that is, before you commit to either, get both numbers and put them side by side. Ask an estate agent what realistically net after all the costs of downsizing are going to be left over, and ask an advisor for an illustration on the same amount and about a retirement interest only mortgage, which lets you pay the interest monthly and stay put. See, downsizing suits you if the home has become too much and you are ready for a fresh start. Equity release suits you if you want to stay put and you can service the interest. And for some, staying at home and adapting their home is going to be better than either of those two options. Now, seen side by side, the right answer usually becomes obvious because it stops being about the money and starts being about the life that you want. Now, I'd love to know which way you're leaning, so do drop a comment below and tell me, are you a stayer or a mover? And if you found this kind of content helpful, please do like and subscribe to the channel. If you've got a question you'd like me to answer, please leave it in the comments and I'll answer it there or do a video. Good luck and goodbye.